Hey guys, welcome to the Chapter 4 recap. This is going to go over retirement and other insurance concepts. Let's go ahead and dive in. Again, Chapter 4, retirement and other insurance concepts. Hope you guys are doing your reading. I'm going to say it over and over again, but make sure you guys are doing your reading. This is just a chapter recap. So, third-party contracts, we've kind of touched on them a little bit in previous recaps, but the general features is the policy owner and the insured are not the same person. Policies written typically for either minors or businesses. Again, the business aspect is the partners, business partners are taking life insurance policies out on each other, or a parent's taking out a life insurance policy for a minor. So again, the third party contract aspect is that the policy owner is not the insured. Life settlements. The policy owner sells the life insurance policy that is no longer needed to a third party. So again, I use the term biatical life insurance settlement. That's typically what it's called. That's typically people who are in the market for it. Maybe the individual's in some dire need for cash and they have a life insurance policy that's paid up. They're going to sell their life insurance policy for cash or for some kind of arrangement or consideration, and that third party is then going to own that life insurance contract, and that's called absolute assignment. Again, guys, assignment basically is just saying we're transferring the ownership. So whenever you hear assignment, think of ownership. Whoever owns the life insurance policy has the assignment over that policy, and the insured does not have to be terminally ill. They don't have to have maybe a year to live or whatever it may be. Any person can do this at any age, sell that life insurance policy that they currently have for cash. But just letting you know, the average person who's going to buy a life insurance policy typically wouldn't buy it unless you have a rather small time period of future living, because for them to pay cash, it's kind of an investment on their end. Hey, if we pay this amount of cash, we're going to get this amount of tax-free income paid out, to us as a beneficiary. So they'll start crunching numbers and kind of figure out, what's a good investment for them at their end. But that's kind of a little bit more information than you probably need for the life settlement aspect. Group life insurance, the general features. The employer is the policy owner. It receives a master contract. The employees are the insured, and they receive the certificates of insurance. I'm sure most of you guys, or maybe someone that has a group life insurance policy through their employer. The employer wants to provide that benefits to their employees. It's a good way to retain a lot of employees, but we'll go into that later on. So the policy owner is the employer. All the insured are the employees. They get certificates of insurance, and the beneficiaries or whoever the employees want it to be and want their life insurance to go to. No evidence of insurability. The main reason is kind of the law, large numbers aspect. Maybe you have 20 employees and they are all different genders and ages. They're just going to give you kind of a base number based off the genders and age. So there's no need for insurability, because the insurance company is saying, hey, maybe there's one or two people that don't have good health, but we're hoping that the remaining amount, the other 18 or 19 people, have really good health, and it's going to be based off age and gender. So there's no evidence for insurability, but you can have a conversion aspect. Again, no evidence of insurability within a specific number of days. Usually it's 30 or 31 days of termination, meaning is maybe that employee leaves, that company, but they still want their group life insurance policy. Then they can take on the payments and carry it with them. A lot of times you'll hear that as called conversion or portability, meaning that you can take it with you. So understand that there is a conversion aspect as well. If you do, quit, get fired, change employers, and you still want to carry on that group life insurance benefit that you have. Non-contributory. So non-contributory, employer pays 100% of the premium and requires 100% of the employee participation. That just means that, the employer is going to pay all the premium, but they need all the employees to participate in it. So Ideally, that's a situation that you'll typically see in group life insurance, because if the employer's paying for it, why would an employee say no to like a free benefit, a free life insurance policy, and even more coverage for their family to leave a legacy or protect their family in the case of their passing? But let's just say, odd situation, it's a contributory group life insurance situation where the employer and the employee share the cost of premium, and that requires a minimum of 75% participation. So typically, the non-contributory, um, group life insurance is really what you're going to see typically, because the employees are going to want the free benefit if it's paid for by the employer. But maybe somebody's like, hey, just give me whatever you would spend on a premium, just put that cash in my pocket. That's where you're going to see maybe some contributory type situations where the employer and employees share the cost of premium, and it requires 75% of participation. Qualified plans. We're kind of getting into the retirement aspect of this section. So the general features: qualified plans are approved by the IRS. The tax benefits are for the employers and the employees. So the employers are saying, hey, this business is not retaining this money, we're passing it down to our employees. And the employees are putting this money into a 401k, 403b, 457, some type of retirement plan, so that, hey, again, the employer is not receiving the money, we're passing down to the employees. The employers are saying, hey, we're not receiving this money, we're putting it into our pre-tax retirement account, which will be taxed on disbursements in retirement. So you get tax benefits for both the employer and both the employee. Very important to understand that those are the qualified plans, and the benefits there. It must be permanent, and you must have a vesting requirement. For the 401ks, all those types of qualified retirement plans, the vesting is typically, hey, you have to be with the company for 3 months, 90 days, or 6 months or a year before you start to get the 401k, you start to get the match and all the benefits from that qualified plan. And you cannot discriminate at all. If once you set the limits, once you set the vesting requirement, you cannot discriminate for any kind of group, whether it's age class, race, gender, sex, whatever it is. It's got to be encompassing of all your employees, regardless of social classes, gender, sex, anything like that. So just know that qualified plans cannot discriminate, and it cannot discriminate based off income as well. That's very important, because you'll see that later on for different types of defined benefit plans moving forward. Individual qualified retirement plans, traditional IRA. This is another type of pre-tax account. The qualified plan is a pre-tax account, but it's an employer retirement plan. The IRA is an individual retirement plan, but it's still a pre-tax account, meaning that you're saying, hey, IRS, I'm not receiving this money, I'm saving for retirement, and I'm going to be taxed later when I withdraw in retirement. So you can fund this traditional IRA based off of earned income. Your contributions, again, it's a pre-tax account, so you're putting pre-tax money in there. There's no limiting age. It's a recent law change. As long as you have earned income, regardless of your age, you can contribute to a traditional IRA. So the dollar limit is up to the maximum allowed, which right now in 2024 is $7,000. It typically goes up each year for inflation. So just know the limits that somebody can contribute to an IRA, but it's going to be a dollar limit and typically going to be adjusted each year for inflation. Married couples, they get the double the amount as singles. Two individuals, they can each have an individual retirement account. Say, I'm putting in $7,000 a year. My wife can put in $7,000 a year for her traditional IRA. So that's all that means, is married couples get double the amount for the singles compared to the singles. Withdrawals may begin at 59 and a half, but no later than age 73. So that's any kind of, retirement plan. Because it's for retirement, they allow you to start taking withdrawals before 59 and a half. If you pull out beforehand, you get a 10% penalty unless it's a qualified qualified pre-retirement withdrawal. Typically that's going to be like medical conditions or maybe buying a first home. There's only a few exclusions, but those are typically the main two that are used. You guys shouldn't have to know that for your test. That's just additional helpful information for whenever you do go meet with clients, so on and so forth. So withdrawals may begin at age 59 and a half, but no later than 73. Age 73 is when you have to start taking RMDs out of your traditional IRA account, which stands for required minimum distributions. It's Uncle Sam, guys. If you haven't paid taxes on this money, Uncle Sam wants their tax dollars. So they basically put a timeline or a deadline of when you have to start taking disbursements so that they can get paid on the money that you deferred the taxes on this entire time. So understand that. A Roth IRA, I'm sure you guys have probably seen videos on social media about it, whatever it may be, but if you haven't seen it, you have to have earned income. The contributions are after tax. So what that means is, hey, the money that we're contributing, we've already paid tax on, and there's no limiting age. Again, you're still going to be limited to $7,000. So whether you have a traditional IRA or a Roth IRA, you can only contribute a maximum of $7,000, whether it's in one or the other or a combination of both. So any kind of IRA, traditional again is pre-tax, Roth is after tax. Any kind of IRA, you can only contribute a maximum of $7,000 per person. So in the Roth, you're paying taxes today, your money grows tax-free. So in retirement, that's why there's no age limit, because Uncle Sam already received their tax money. That money's going to grow tax-free, and you make tax-free disbursements and withdrawals during that retirement age. Again, withdrawals do not have to begin at age 73, but to avoid penalties, it does have to happen after 59 and a half, unless there's certain and specific qualified reasons. Again, guys, I don't anticipate that you will have to know that on your exam, but just know the difference between traditional and Roth IRAs, and then that you are maxed out at a dollar amount. It shouldn't have 7,000 on there, but just know that traditional IRA pre-tax, Roth IRA post-tax, and you're maxed out based off of a dollar amount for that year. And then you can only take disbursements after 59 and a half without penalty. And then traditional IRA, you got to take out at age 73 because of RMDs. Employer-sponsored qualified plans. Contributions up to the IRS specified limits. Similar to the IRAs, they're going to put a limit on how much you can contribute, but the employer-sponsored plans, your 401ks, your 403bs, they're going to have much more of a higher contribution limit. Right now, it's about $23,500 unless you have catch up or whatever it is, because you're a little bit closer to retirement. But they're still going to limit on how much you can put into those employer-sponsored plans as well. So contributions up to the IRS specified amounts, both employer and employees can contribute. That's whenever you get a match from your employer. Let's say your employer's matching, 100% match up to 4%. And you put in 4%, you're going to get 8% of, your salary, 8% of your yearly salary that's going to go to your 401k or employer-sponsored plan. The different types of plans is the HR10 KEO. Pretty sure I'm pronouncing that right. I had to Google it. It's an Irish name, but it's like KEO. I would have called it KEO if I didn't go look it up. But I don't want to tell you guys wrong. So that's for self-employed. If you're self-employed, you can open up that HR10 kind of account, or you can do a SEP. A lot of people typically will do SEP or simple IRAs. So a SEP account or a SEP employer sponsored qualified plan is a small employer, or you're self-employed where employer funds the employee's IRA. You have a little bit more flexibility in the investment options in an IRA compared to a 401k. Then you can also have a simple IRA, which is a small employer, no more than 100 employees. It's set up as an IRA or a 401k. Typically, it's going to be a simple IRA, but you can see 401k as well. 401k, any kind of employer, cash or deferred arrangements and profit sharing. Again, guys, you can have a profit sharing aspect where maybe they give you stock options or whatever in that company if it's a really big company. But typically, they're going to do the deferred arrangements and contribute to that plan through a match. 403b, nonprofit organization. Typically, it's going to be, your teachers. Teachers are really going to have a lot of 403bs along with their TRS, but that's besides the point. The teachers are going to have 403b, and some different nonprofit organizations, maybe types of churches. Typically, churches are going to be 457, but they could be 403b too, as well. And that's a tax sheltered annuity. That's how they utilize that through the investment aspect. But so the 403b, nonprofit organizations, and think of teachers specifically, 401k, any kind of employer, they're going to do the match typically, maybe some profit sharing. Simple, small, but less than 100 employees, set kind of a smaller S word. So think of, a really small self-employed or small employer, for an IRA. And then the HR 10 is just totally self-employed, just kind of a single, a sole prop type situation. But I don't anticipate that you'll need to know a lot about the specific types of employer-sponsored qualified plans, but you really just kind of need to know some of the factors and the different aspects of an employer-sponsored qualified plan. Taxation, life insurance. Premiums are not tax deductible. You don't get any tax benefits for your premiums. You got to pay taxes on whatever premiums you give. The cash value is taxable only if the amount exceeds the premiums, so you're taxed on gains. The policy loans are non-taxable. The interest is not tax deductible, though. Again, so you build up that cash value. Typically, you want to pull from the principal aspect of your cash value, whatever premiums that you put in, so that you don't have to worry about the tax aspect. But the policy loans are not taxable. The interest is not tax deductible. Again, the cash value is going to say that you will be taxed on the gains inside of that account. So again, I recommend if somebody wants to look at a loan, try to pull from principal as far as the premiums paid if you can help that situation. Dividends. Dividends are not taxable as return of premium. Any interest that you gain outside of that is taxable. So understand that. That's why, the return of premium aspect can be good because it's not going to be taxable. They're giving you your money back essentially. But any dividends, as far as the interest that you gain, is going to be taxable. Very important to understand that. The death benefit is not taxable if it's a lump sum. But if you do, for example, if you do periodic payments and that cash value or, whatever death benefit they have you is still gaining interest, and the interest that you gain on that lump sum will be taxable. So typically 99 times out of 100, the beneficiaries are going to receive that non-taxable lump sum. A lot of people don't typically do, periodic payments where that interest is going to be taxed. So important to understand the taxation when it comes to cash value life insurance and the premiums associated. IRAs, contributions, and this is mostly the pre-tax dollars are tax deductible but must be made in cash. That's, again, talking about your traditional IRA. That's going to be your pre-tax dollars. That's where you're going to get the tax deductions. Obviously, must be made in cash. Your earnings are going to be tax deferred. So what that means, again, is we're putting our money in there. We're going to be taxed later on. So deferring that tax to withdrawals. Say we have a traditional IRA and we have $1 million in there. Everyone's, I have $1 million in my IRA. That's great. But in reality, 20%, 30% of that's going to go to Uncle Sam and the IRS. So just understand that. Distributions are taxable. We deferred all these taxes. Uncle Sam's going to get their money, so the distributions are going to be taxable. Again, I mentioned it earlier, you're going to have a 10% penalty for early withdrawals, which is anytime before 59 and a half years old. Roth IRAs. This is where the contributions are after-tax dollars and not tax deductible. We're paying the taxes today for tax-free growth. So if we have a Roth IRA and we pay taxes on all of our contributions, that money's going to grow tax-free. And if we have $1 million at that point, we truly have $1 million. We already paid Uncle Sam. We don't have to worry about it twice. And all those distributions are going to be non-taxable. Business insurance. Employer contributions are going to be tax deductible to the employer, not taxed as income to the employee. The earnings grow tax deferred. So again, kind of like I mentioned, when the employer is saying, hey, this company's not receiving this money, we're passing it down to the employees. through that group life insurance, or whether or even the 401ks or whatever. But the company's not receiving this money. We're passing it down to the employer, so they get tax deductions, and it's not taxed as income to the employee because they're receiving the benefit later on. It's paying for life insurance. This is the business insurance aspect. So they're talking about group life insurance. So it's not taxed as income. It's just a benefit that the employee gets, and they're not taxed on it. The earnings grow tax deferred if they do have some kind of cash value, or if they're referring to the 401k, obviously your money's going to grow tax deferred later on. Lump sum distributions to employees have favorable tax treatment. So the lump sum distributions, if you have a life insurance policy, they're going to pay out. It's going to obviously not be taxed unless it's some kind of whole life policy. You're going to be more favorable. Maybe you have to pay on the interest if you do the different types of, period certain or period fixed, whatever it may be. Other related concepts. This is more the rollover and transfers. This is typically talking about whenever you roll over a 401k to an IRA. It's a really wise decision for somebody to do who is no longer working at that employer, or maybe they got fired, took another job, and they still have that 401k sitting there. Maybe they're retired, or maybe they're the age over 59 and a half. You can do a tax-free transaction by moving it over to an IRA. It's the distribution of money from one qualified retirement plan to another. That can be 401k to 401k, or that can be 401k to IRA. So very important to understand that. Must be completed in 60 days. This is talking about an indirect rollover. So what that means is, hey, we're working for this company. We want to move our money to an IRA. The company is going to send you a check of whatever your 401k balance is, and they're going to have you pay that, take that check and send it to that, new financial institution where your IRA is. I really don't recommend doing that, guys. If you can help it, do from, a plan to a trustee, or financial institution to financial institution. That's called a direct rollover. You don't have any withholdings. They don't send you a check. It's just a lot cleaner, a lot simpler, and you don't have to worry about it. But if you do the indirect rollover, if you go from plan, like I said, to just participant to another financial institution, they're going to hold 20% for taxes just in case, for God forbid, you don't get that money there in 60 days. So when you're doing rollovers in real life situation, you want to do a direct rollover every single time. But just know that you can transfer your qualified plan from 401k to 401k without any tax consequences. And you can do 401k to traditional IRA without any tax consequences. Modified endowment contract. I've kind of talked about it before. And this is how you break what is called the MET test. And this is breaking the IRS code, where now your premiums and stuff in the life insurance policy become taxable. So this means you overfunded a life insurance policy. The fastest you can, fund a permanent life insurance policy is doing the 7-pay test, where you pay for the entire life insurance policy in 7 years. So you overfunded it. You did, beyond the maximum amount that they'll allow. So the accumulation is going to be tax deferred. The distributions are going to be taxable as last in, first out. So the last money in is going to be first out, and you'll have distributions before 59 and a half. That's going to be a 10% penalty, guys. On every single life insurance illustration that you're going to do, that's going to be tied to the application. You're going to have that MEC test on there. Life insurance companies don't want you to do that. Carriers don't want you to do that. People that help you will make sure that you don't do that. We will make sure that you don't do that, because that basically gets rid of all the benefits of having a life insurance policy, because now a lot of that's taxable. That's why the accumulations can be tax deferred, but you'll be taxed out, the last in. So, any money that goes over that MEC limit is going to be taxable, and that's going to be the first thing that you pull out. It just becomes kind of an issue. Just make sure that you don't, break the MET test, which is a 7-pay test. And obviously that'll be on all your illustrations, and we'll have trainings for that. But just know that the modified endowment contract basically takes away the cash value, tax-free aspect of a life insurance policy. Social Security benefits. The different types of benefits are retirement, disability, survivor. I'm sure a lot of people who have parents or grandparents who are collecting Social Security, they're getting fixed monthly, payments every single month because of how much they worked and how much they paid the IRS, so on and so forth. You get disability aspects if you get disability, and then survivor. Your spouse can take on, your retirement proceeds, or even your ex-spouse if y'all were married long enough. There's certain time limits there. Again, that's extra information. But just know that Social Security benefits have the different types of benefits regarding retirement, disability, survivor. Again, guys, I don't anticipate you guys get tested on that, but just good information to know. Insured status. So to obtain your fully insured Social Security benefits, you have to have 40 quarters of coverage, 10 years, guys. There's 4 quarters in a year. So 10 years of working, paying the IRS, all that good stuff. You're going to be fully insured and qualified for Social Security retirement, Medicare, and survivor benefits. So very important to understand 40 quarters or 10 years. It might be phrased either way on your exam. Currently insured means you have 6 quarters of coverage or, a year and a half to qualify for some benefits. So really, 6 quarters is the bare minimum where you get some benefits, a year and a half, but 10 years is where you get fully insured for your Social Security. Guys, we talked about a lot of different concepts in here. This is a very broad type of section and chapter. It talks a lot about retirement, qualified, employer-sponsored plans. I know this stuff can be confusing. So make sure you kind of look over this video again. Make sure you look through this information really well and go through the chapter recap. I don't anticipate that this will be a highly tested chapter or section of the exam, but it's really good for you guys to know for obviously your real life business, building your book of business and helping clients out even more. If you have this knowledge, it's only going to make you more competent and more capable to help your clients. But I do not anticipate a lot of this to be on the exam. Again, it's great information to know. So hopefully this chapter 4 recap really helped you guys, and we'll be able to help you guys along and really solidify some of these concepts on our trainings throughout the weeks. So thank you guys. Thanks for listening. Have a great one.